Welcome to the monthly 3-Edge View from the Edge for February 2022. I'm Fritz Folts, the Chief Investment Strategist here at 3-Edge, and I'm joined here today once again by Eric Biegeleisen, Director of Investment Research and Deputy Chief Investment Officer of 3-Edge Asset Management. And as we do at the beginning of each month, Eric and I will provide our firm's most recent outlook for the global capital markets, which is based on our proprietary research model. We have a lot to cover today, so let's get started. And let's first take a brief look at the activity in the global markets this past week. And during last week's 3-Edge Week in Review video with Steve Cucchiaro, Steve and I discussed the volatile market environment since the beginning of the year and the debate over whether investors would be buying the dips or selling the rallies. And well, this week they did both. The equity markets rallied at the beginning of the week and then sold off rather dramatically on Thursday, led by the parent company of Facebook, Meta, which saw its market value decline by over $200 billion. Rapid decline seemed to reinforce the adage that stocks can take the escalator on the way up and the elevator on the way down. Equity market volatility this week illustrates heightened level of investor uncertainty as they seek to understand the implications of the Federal Reserve's policy shift away from easy monetary policy and towards monetary tightening in order to combat inflationary pressure throughout the economy. So let me bring Eric here into the conversation. And why don't we start, Eric, with looking at our 3-Edge matrix and have an overview of the different asset classes that we model.
Sure. Thanks, Fritz. Yeah, as you can see here, not a lot of moving parts. Typically, we would be showing arrows, moving boxes left or right, and nothing really has changed too much from last month, though many asset classes are near critical inflection points, which could easily move them up or down from here. So generally, though, what we're seeing is a fairly negative outlook on international equities, with India being a bit of an outlier there, having a positive outlook, while U.S. equities is more mixed. Real assets, particularly commodities, which had a great 2021 and a great January, continues to have a positive outlook. And the outlook for fixed income, both rates and credit, are not particularly favorable, though, like in the case of U.S. equities, there are pockets of value that we'll touch on.
Excellent. All right, so let's begin. We'll take a deeper dive into the equity asset classes, beginning with U.S. And first, why don't we throw up this chart, and you can comment on that because it is kind of interesting. The chart will show a fairly narrow band and an upward trend for the S&P 500 that now just recently has been broken to the downside. And as you and I discussed in our business, you can often draw lines across charts forever to make a point, but it may be telling that for the first time in years, it's broken below that band. So why don't you maybe comment on that and then get into a little more detail in terms of what the model thinks about the U.S. equity market?
Yeah, I mean, there's certainly a notable uptrend since the bottom of the pandemic in March of 2020. But it is just a chart, and as you pointed out, you can connect any 2 points with a line. So it may not ultimately be the beginning of the next bear market, but it is notable that something perhaps is different this go around with the more recent sell-off that we've seen. Yeah. All that said, and I feel like I sound like a bit of a broken record here, but U.S. equities, and particularly the growthier type names that you find inside of the S&P 500, remain highly overvalued by our measure. And what we're seeing the Federal Reserve Board, which recently announced that it will continue to add stimulus until at least March, leaving its Fed funds rate near zero and continuing to expand its balance sheet, which in theory should support the stock market. All that said, the Fed did raise the prospect of tightening its policy beginning no earlier than March, should inflation remain elevated and unemployment remain low. Details on the size of rate and the frequency of rate hikes, as well as, balance sheet reduction, the runoff, it's still unknown. And the Fed themselves, as you pointed out, may not yet know what they're going to do. In regards to the model, our measures of the yield curve slope are sufficiently steep in the U.S., which is supportive of equities. But there has been a small but notable widening of credit spreads that we saw in January. And that could be an early warning sign of an economic slowdown coming. More importantly, would be the potential for an abrupt shift in policy by the Fed to a stronger inflation fighting response, which would, could trigger a more serious equity market correction than we've already seen. So in this environment of rising rates, we would find higher quality names and/or value-oriented equities. Those might be the types of investments that may outperform.
Yeah, and you could look at what happened in Facebook or Meta, and it was one day, it was one data point, but that was a major decline of one of the favorite growth stocks that have been leading this market higher. So maybe it's instructive what might be to come anyway.
That's right.
Good. So let's go outside the U.S. now. Ex-U.S. equity markets, but developed markets. So we'll look at Europe and we'll look at Japan.
Sure. Yeah. Inflationary pressures remain elevated across Europe. The latest inflation print climbed up over 5%, which is a record for the region. Concerns over the potential for the European Central Bank or the ECB to take more aggressive action in response to this inflationary pressure than market participants currently anticipate could prove to be a headwind for European equity investments. In addition, continued widening of investment grade and high yield credit spreads in the region also compounds this concern. So overall, we just maintain that negative outlook.
Mm-hmm.
And for Japanese equities,
yeah.
Japanese equities, the potential to regain a more positive outlook exists as we are seeing a tightening of credit spreads, kind of bucking the trend in Japan here. But indicators of investor psychology show a more negative outlook short term. So on balance, this combination of factors contribute to keeping that negative outlook for Japanese equities in the near term.
Great. All right. So let's stay outside the U.S. in the equity markets and look at emerging markets. And this will look at India and China.
Yeah, so India, fantastic 2021 performance there. And while India was flat in January, that was still great relative outperformance versus other major equity markets that we model, which were down for the month. We had previously noted concerns a month ago in India, specifically around the widening of the TED spread measure, which is an indicator of stress in the financial system. But that's done a bit of an about face and is less of a concern right now. Our yield curve measure for the region has continued to steepen, which is a positive for the prospects of future growth. So the overall outlook for India or Indian equities remains positive. And then like India, China had a relatively flat January as well. However, unlike India, China was down over 20% last year. We're still seeing, as a follow-on from that, we're seeing negative investor psychology in the region and flattening yield curve measures, which is also a negative. So we'd really need to see a significant tightening of credit spreads alongside steeper yield curve measures to improve the environment for investments in Chinese equities. So for us, the outlook remains negative.
Great. All right. Let's look at the bond market, fixed income markets, where we are seeing some potential changes there, right? And our research is showing that we're seeing yields are potentially starting to rise, and investors are trying to figure out how much that's going to happen. And so it's almost like there could be more action in the fixed income markets in the days to come. But what is the model telling us about both what we would call rates, which would be U.S. Treasury securities, as well as credit, which would be the corporate bond market? What are we seeing there?
Yeah, inflationary pressures and negative real interest rates just continue to pose a threat to the income that you earn from owning bonds. At the same time, you have rising interest rates, which weigh on the value of bond holdings through price depreciation. Not a great combination. So we don't really favor nominal treasuries other than what's required or necessary for having a diversified portfolio. Instead, our research favors inflation-protected securities, or TIPS, as they're known, as well as Treasury floating rate securities, both of which may perform well in an inflationary and/or rising rate environment. As the outlook for credit goes, that remains negative. The risk of continued credit spread widening that we've touched on would likely reduce the principal value of corporate debt and make it even more challenging for debtors to refinance their existing debts, putting further stress on yields upward.
Excellent. So just going back to the interest rate environment, one thing of note was on Friday, I believe both German and Japanese 5-year debt finally broke through to actually have a positive yield, which, we haven't had in a very long time. So we'll have to see what develops there. So let's shift gears out of fixed income, look at the real asset market. That would be both gold and commodities. And why don't we start with gold, which is, it's off a bit this year, but I mean, it's holding up fairly well in the face of declining stocks and bonds. But what is the model telling us about the market for gold?
Sure. Yeah. So gold, negative performer for the calendar year last year, though in the fourth quarter it was up about 4%,
Hmm.
down a little bit in January. We've seen a big increase in yields recently that you just touched on. With the presumption of the rate liftoff in the months ahead, expected by the Federal Reserve. And this recent increase in nominal rates has largely been matched by an increase in real rates. So that's a headwind for gold short term.
Hmm.
That said, real rates are still quite negative, which longer term is positive for gold. And then beyond, what's going on in the interest rate market, rising geopolitical uncertainty. You have conflicts between Russia and Ukraine. You have Taiwan and China. You have North Korea. That alongside global inflationary pressures that we've noted in a number of regions, that should both serve gold, well in a diversified portfolio as a hedge.
Excellent. All right. So we'll shift gears again and we'll look at the commodities market, another part of the under the umbrella of real assets. And as you said, strong 2021, strong start here in 2022.
Yeah.
Probably a bunch of that is from the price of oil, which I think is over $90 a barrel now. But what is the model seeing? What are we seeing there in terms of commodities?
Yeah, fantastic. 2021 up over 40% from the broad basket that we look at. Another 7% in January. Our research continues to find commodities favorable. If there were some concerns that could alter this outlook, we'd be looking at this widening of credit spreads in the U.S. that we've been talking about. Another would be a more significant slowdown in the emerging markets than is anticipated. So either of these might challenge the outlook, but in the absence of those, we do continue to find commodities favorable.
Excellent. Great. Good. Thank you, Eric. Thanks for getting us caught up on the view from the edge for February. Eric and I will be back again at the beginning of March with the next edition of the Three Edge View from the Edge. And if you'd like a copy of the full Three Edge View from the Edge newsletter for February of 2022, you will find the print version on our website at 3edgeam.com. In addition, all of our video content is always available on our Three Edge YouTube channel. So that will do it for Eric and me. Steve Cucchiaro and I will be back next week with our Three Edge Week in Review. So on behalf of Eric and everyone here at Three Edge, thanks for listening.